Imagine two friends, both open accounts on the same day. Both start with 100,000 rupees. Both trade the same stocks. But one ends rich, the other ends broke. How? Same market, same chances, different mindsets. Think of it as two students in the same class. Same teacher, same books. One passes with flying colors, the other fails. The difference? Discipline and mindset. Sohan and Mohan both had knowledge. Both read the news, both studied charts. But Sohan traded with emotions. Mohan traded with discipline. Sohan celebrated small wins, then risked too much. Mohan took small, steady steps. Sohan held on to losses, hoping they would turn green. Mohan cut losses quickly, never letting them grow. Sohan's account shrank. Mohan's account grew. The problem was not the market. It was psychology, like two people going to the gym. One lifts randomly, no routine. The other follows a plan, slowly builds strength. After 1 year, the results are very different. Studies across the world confirm this pattern. Overconfidence. Trap. After a win, traders increase risk too much. Loss aversion. Traders hold losers longer than winners. Discipline versus emotion. Disciplined traders survive longer, even with lower accuracy.
Over 93% of traders lose money in the markets. Not because of the market, but because of their mindset. Hi, I'm GC Sharma, founder of Ghar Ghar Investor, former head of financial education at the National Stock Exchange. After 3 decades in the markets, I'm here to help you trade with discipline, not emotion. Welcome to Bounce Back Trader, India's free YouTube learning series for traders who want to bounce back with clarity and confidence.
A SEBI study showed that intraday traders who survived 1 year had one thing in common: they respected stop loss and position sizing. Global research by Barber and Odin found that traders who churned accounts the most lost the most. It is not about how smart you are. It is about how calm you are. This pattern is not limited to India or the US. In Korea and Taiwan, similar studies showed that only a small fraction of day traders made consistent money. The rest lost mainly because of poor discipline, not lack of opportunity. Sohan was not foolish, but his brain tricked him. 1. Excitement addiction. He loved the thrill of action. He could not sit idle. 2. Revenge trading. After every loss, he doubled size to recover. 3. Ego. He could not admit he was wrong. He held on too long. 4. Greed. After one win, he thought he was invincible. 5. Fear. When trade went against him, he froze. Mohan felt the same emotions. But Mohan had rules. Rules protected him from his own mind. It is like cricket. Every batsman feels pressure. But the disciplined one leaves bad balls and waits for the right shot. The impatient one swings at everything and gets out quickly. Day 1, both bought the same stock at 500 rupees. It rose to 520 rupees. Sohan sold quickly to lock profit. Mohan held with a trailing stop. The stock went to 550 rupees. Mohan gained more. Sohan regretted. Day 15, both bought another stock at 300 rupees. It dropped to 270 rupees. Sohan held, hoping it would bounce back. It fell to 240 rupees. He lost 60 rupees per share. Mohan sold at 285 rupees, booking only a 15 rupees loss. Sohan said, "You are weak." Mohan said, "I am safe." Month 3, Sohan had lost half his capital. He was angry, frustrated, and desperate. Mohan had grown slowly, 10% up. Not flashy, but safe. Month 6, Sohan borrowed money to recover losses. He traded bigger, faster, and more carelessly. Losses mounted. Mohan, on the other hand, spent evenings reviewing his trades. He learned from mistakes, adjusted strategies, and improved. Year-end, Sohan's account balance, 20,000 rupees. Mohan's account balance, 150,000 rupees. Same market, different psychology, Different results. Sohan left trading, blaming the market and brokers. Mohan continued, slowly building wealth and confidence. 1. Rules beat emotions. Mohan always used stop loss. Sohan traded on hope. 2. Patience paced. Mohan let profits run with trailing stops. Sohan booked profits too early. 3. Cut losses fast. Mohan accepted small losses. Sohan turned small losses into disasters. 4. Risk management is key. Mohan never risked more than 2% per trade. Sohan sometimes risked 20% in one shot. 5. Mindset over knowledge. Both had same knowledge, but Mohan managed emotions. That made all the difference. This lesson applies outside trading too. In exams, sports, or business, the disciplined player always lasts longer than the impulsive one. The market does not care about your name. It does not care about your feelings. It rewards discipline. It punishes emotions. Sohan is every trader who follows impulse. Mohan is every trader who follows a plan. Reflection question: am I Sohan today, or am I Mohan? Action step: write your own Mohan rules list. Maximum 3 trades per day. Always use stop loss. Never risk more than 2%. Reward discipline, not profit. Final analogy: trading is like driving on a highway. Sohan drives fast, no seatbelt, always honking. Mohan drives steady, follows rules, reaches destination. Both started the same journey. Only one reached safely. The choice is yours: rush and crash, or pace and progress.
You've just completed another lesson of Bounce Back Trader. Remember, trade with discipline, not emotion. Subscribe to the channel, share your thoughts in the comments, and continue your journey in the next video. Let's change that 93% story.